Robschild. Nothing I say is investment advice. Welcome to the show where we view financial markets through crystal ball gazing. JP Morgan once said millionaires don't need astrologers, but billionaires do. And so we begin. I did not make a video on the previous Friday. Today is, by the way, February 5th, 2024. I skipped the show on February 2nd on the Friday, mainly because I realized I was halfway through making the show and I just realized how difficult crystal ball reading is right now as far as markets go. And that's kind of generally what's going on here. I have my own crystal ball longer term views, but on a shorter term basis, it's hard to say where things are going. On Thursday, I had noted on the 30-year bond yield that it looked like it had been collapsing with a very clear three white shoulders pattern. This is very bearish on the yields and bullish in bonds, and I had said it looks like we're gonna break through this low pretty easily, and had having this be basically a head and shoulders pattern, had headed down maybe as far as going down to 3%. But instead, the very next day on Friday, it popped, and then again, we had it pop right back up today. On Thursday of last week, we saw initial jobless claims being higher than expected, which is ironically good for markets because it means that the Fed has more of a reason to cut sooner. But then on Friday, this number in the middle here was the expected amount of U.S. jobs gotten in January. It was expected, the previous month, so in December it was 333,000. It was expected to only be 185,000, and instead it was 353. This is likely what caused this major reversal on Friday, and we had some follow through today on that yield. Regarding crystal ball rating, we have some interesting developments. I had pointed out in previous shows a potential head and shoulders using this line right here. Oops, let's get the right line. Showing the shoulder being here. However, now, if we adjust it like this, and if we consider this to be the neckline here, which would be a pretty nice little trend line here, which we'll add more to in a second, we can see a shoulder here, head here, and this could end up being the shoulder that I was looking for earlier, heading us to the target of around 4.8%. Now, if we zoom out on this chart a little bit, we can take this same line and see even bigger patterns developing here that are notable, mainly potential head and shoulders here. 1, 2, 3. And so even if this does pop up to the 4.8 region, we can still have this count as a potential shoulder there. And then if we zoom out further, we can try to come up with some more trend lines. You can see this one right here has been pretty sturdy. And then once again, is this a head and shoulders? My point here is that I still am of the belief that overall yields are going to be headed lower, that if we do see a spike in yields, they're going to be temporary. The real cost to money is going to create a lot of drag on businesses to be able to make money. The Fed is strangling the economy. They are trying to slow it down, and they will win eventually. That's how this game works. That's why the yield curve is inverted. And so I see very clearly in my crystal ball that interest rates will eventually break. I'm thinking for sure within a year, which would entail that Treasury bonds are a very good investment for this time period. Low risk, no risk really, except for the fact that if you want to sell them back into the market before expiration, the value will go down from your purchase price if the yields go up. But, you know, if they go down and you're holding like a fund, or your intention is to hold it for a shorter amount of time, it can be extremely profitable. Again, nothing is investment advice, but I feel very strongly about how this is going to play out. Well, think very strongly about it, see very strongly about it, however you want to put it. I have a strong conviction on this, and right now for myself I have about 40% of my portfolio in ZROZ, a long duration treasury bond fund. The most interesting chart going on right now, very short term, is this continuing divergence between TLT and HYT. So TLT represents treasury bonds, HYT represents high yield corporate bonds, so bonds that are considered to have higher risk. Now, you know, typically when interest rates on a guaranteed bond, being a treasury, is, you know, moving up while, you know, the value of the bonds are going down, you might expect to see a similar move in something like HYT, where there's much higher risk involved. It's acting as if high yield corporate bonds are safer than treasury bonds, which is actually ridiculous. You know, when treasury bond yields go up, it puts higher risk on everything. You know, in addition to the fact that HYT is higher risk to begin with. And so I find this divergence to be interesting, and it will be very interesting to see how it plays out. The next interesting chart to mention is the CME Fed Watch tool, the Fed Funds futures rates. This one over here is no cut in March, saying it's an 84% chance now no cut in March. And now we have additionally no cut between June and July here, where before we were looking at cut. We were looking at 6 cuts, and now we're actually only looking at 5. So now the market is seeing this, and it was largely off of the back of this data we had on Friday. Again, this, where is it? This U.S. jobs report. That number is just so strong that, you know, it really convinced markets that the Fed is, well, the Fed's not done being as hawkish as it has been, and so we're seeing it tighten. And, you know, additionally to this, what's interesting is the Fed has been very clear that they only are looking at potentially 3 cuts this year in 2024, and the market does not believe them. They're still saying, nope, no, Jerome, we're doing 5. We're doing 5. And like I've said before in other videos, you know, the Fed funds future is a better crystal ball than actually listening to the Fed talk, because it just ends up working out that way. The market kind of prices in what's going to happen regardless of what the Fed says they're necessarily going to do. You know, if we continue to see, if we start seeing inflation ticking back up, for example, CPI reports starting to go up, then maybe Fed funds futures will start going the other direction and taking out some of the cuts that are priced in. But right now, as of today, they're saying, you know, not so many cuts. And, you know, the worst part about all of this is, like, let's say we do see inflation ticking higher, and then we do see the Fed funds say, oh, now that we are really only looking at 3 cuts. You know, that tighter policy is going to lead to even a stronger, you know, strangling of the economy, and this all leads to a harder and harder and harder landing, which usually equates in a larger and larger collapse in the stock market. But, you know, it's all in the crystal ball. 2 more charts real quick. This is the S&P 500. We had A little reversal from Friday's new all-time high of around 49.72. We're still kind of looking, still kind of expecting to at least get up to this 5,000 level. And, you know, just from looking as a pure chart perspective, on top of the fact that, you know, funny enough, you know, earnings being strong, jobs being strong, economy is hot, economy is good. You know, this looks like it wants to keep going up. And as I've said in previous video, my crystal ball actually does see a movement past 5,000 in the S&P 500. We could be going quite a bit higher. But it, you know, it's not, I don't see it as being very safe up there. And I find the higher we go, the less safe it gets. So, you know, I think caution is a good idea right now. Again, never any advice. Last chart I just wanted to go through, lithium miners. This thing has been getting severely beaten down. It's just another one of these little ETFs that, you know, you can potentially take advantage of on especially on a short-term basis. This thing opened up not that long ago. You know, in the summer of 2023, we were at $25. We're now at $11, and so, you know, and even just back in December, $15 down to, you know, $12. This is a big move down in a relatively newish and important industry that's not going to be going away. As long as we have electric cars, it's pretty clear that lithium is going to continue to be an important resource. And I think the selling is getting overdone here. And I think it's hilarious how we're seeing all-time highs in the S&P 500 and ILIT and similar funds like the REMX miners funds, which actually holds a lot of lithium miners itself. Once this chart starts adding more length, it should actually start looking pretty similar to the REMX chart, which I mentioned in previous videos is looking pretty darn oversold as well. Again, hilariously in the face of the S&P 500 getting to all-time highs. It's getting dangerous out there overall. It's getting dangerous out there overall. It's getting really choppy out there. Moves like this in the 30-year bond yield are those are very large moves. We don't often see this much violence in Treasury bond yields. So it'll be really interesting to see where we play out from here. I'm still seeing in my crystal ball getting up to around the 4.7, 4.8 range in the 30-year bond yield before turning over. And I've said before, if we get up there, I'll be participating in that at that time. And that's all I have for you today. Thank you very much for watching. Robschild.